So you want to own a casino. The games aren't gambling, not for the house. Every table, every slot machine, every sportsbook line is built on a mathematically guaranteed edge calculated to the 0.1%. And the casino's actual product isn't entertainment. It's the license to legally operate a business where the outcome is statistically certain over volume. Everything else, the comps, the free rooms, the architecture, the tower, exists to solve one problem: getting enough volume through those guaranteed edge games to convert a mathematical certainty into cash flow, and to do it inside one of the most tightly rationed regulatory structures in American business. The build, and why this is the most capital-intensive business in this entire series. A full-scale commercial casino resort, gaming floor, hotel tower, restaurants, entertainment venue, back-of-house infrastructure, including power and climate systems sized for a small city, routinely runs into the hundreds of millions to multiple billions of dollars. This isn't a business you can enter at small scale the way you can a car wash or a laundromat. The capital intensity itself is a structural barrier that keeps the number of serious operators small, on top of the licensing barrier described next. A single power and climate plant sized for a large integrated resort can run well into 9 figures on its own, a cost that becomes critical later in this video. Mechanism 1. The gaming license makes a liquor license look loosely regulated by comparison.
Where the nightclub industry has roughly 17 quota states, gaming licensing is restrictive almost everywhere. And in several states, the cap isn't a population ratio, it's a fixed small number set by statute. Maryland caps the entire state at 6 casino licenses, full stop. Indiana caps how many licenses any single operator can hold at 2, regardless of how many properties that operator might want to run. Licenses under gaming law are explicitly non-transferable without direct regulatory approval in the vast majority of jurisdictions, which closes off the kind of private secondary market that exists for liquor licenses in quota states. You generally can't just buy a casino license from an existing holder the way you'd buy a New Jersey liquor license. You have to be approved by the state directly, and the state controls how many approvals exist at all. The fees and tax structure vary so dramatically between states that jurisdiction selection is itself the single most important financial decision an operator makes, more than location, more than property design. Pennsylvania charges $10 million for an online casino license and another $10 million for online sports betting if an operator wants both, on top of a 54% tax rate on slot revenue, the highest in the country. New York charges $25 million for an online sports betting license alone. Nevada, by contrast, taxes gaming revenue at roughly 8%, among the lowest rates nationally, which is a large part of why Nevada remains the benchmark jurisdiction, despite having none of the population-driven urgency that makes East Coast markets attractive. An operator evaluating 2 otherwise identical markets can see effective profitability differ by tens of millions of dollars a year, purely based on which side of a state line the property sits on, before a single card is dealt.
Background investigation requirements compound the barrier. Personal, financial, and background investigations extend to anyone holding 5% or more ownership in a private operator, and 15% or more for a publicly traded one, a level of personal scrutiny that doesn't exist for almost any other business license in this series, liquor included. This is deliberate. Gaming regulators are explicitly trying to keep organized crime and undisclosed financial interests out of an industry that handles enormous cash volumes, and the ownership transparency requirement is the primary tool for doing it. Mechanism 2. The house edge isn't a marketing claim. It's a calculated, guaranteed mathematical certainty over volume, and every game on the floor is engineered around it. House advantage, also called house edge or theoretical win percentage, is the percentage of every dollar wagered that the casino expects to keep over a large enough number of bets. Double Zero Roulette runs a 5.3% house edge. Blackjack against a skilled basic strategy player can run as low as 0.5 to 2%, which is precisely why casinos price table minimums and rules variations, deck count, dealer hit soft 17, surrender availability, specifically to tune that edge upward or downward depending on how much they want to attract skilled players versus protect margin. Slot machines run considerably wider, typically a 2 to 10% edge in Las Vegas. And because slot machines are entirely programmable, that edge is a configuration choice, not a fixed law of the game, which is why the exact payback percentage on a given machine is itself a regulated, audited number in every gaming jurisdiction. This is the part that separates a casino from every other business in this series. The operator isn't hoping for a good month the way a restaurant or a gym hopes for strong bookings. Over sufficient volume, the house edge is a law of large numbers working in the operator's favor with near certainty, which is exactly why casino financial models are built around handle, total dollars wagered, rather than around anything resembling traditional retail revenue forecasting. Mechanism 3. Comps are not hospitality. They're customer acquisition cost, calculated per player in real time against a specific dollar figure called theoretical loss. Every serious casino tracks player value through a single number, theoretical win, or theo, calculated as average bet multiplied by rounds or hands per hour, multiplied by hours played, multiplied by the house edge for that specific game and bet level.
A player wagering $100 a hand at a table with a 1.5% house edge playing 60 hands an hour for 3 hours generates a theoretical loss to the house of roughly $270, regardless of whether that player actually wins or loses that specific session. The casino then returns a percentage of that theoretical figure back to the player as comps, free rooms, meals, show tickets, sometimes direct cash back, calibrated so the comp cost stays comfortably below the expected revenue that player represents. This is why every player's club card exists. Without it, the casino has no way to attribute play to an individual, and therefore no way to calculate theo, which is why pit bosses and slot hosts are trained specifically to ensure high-value players are carded and tracked, because an untracked high roller is, from the casino's financial modeling perspective, indistinguishable from a player worth nothing at all. Slot machine tracking is even more precise than table games, since the machine itself logs exact coin-in, number of spins, and time played automatically, which is why digital slot players routinely receive faster, more granular comp offers than table game players, whose theo depends partly on a pit boss's manual estimate of bet size and hands per hour. The entire rewards program that looks like hospitality from the customer side of the counter is, on the casino side,
a real-time customer lifetime value calculation, running against a known, mathematically guaranteed margin. Mechanism 4. The physical design of the floor exists to maximize time on device and rounds per hour, because both variables multiply directly into theoretical win. Casino floor layouts are famously maze-like. Low ceilings over slot areas, an absence of clocks and exterior windows, winding paths between table games specifically engineered to maximize how long a player remains on the floor and how often they pass additional games on the way to anywhere else, restrooms, exits, the hotel elevator. This is an atmosphere for its own sake. Every additional minute on a gaming floor is additional expected handle, and every additional hand or spin per hour directly increases theoretical win for a given bet size, which is why casinos invest heavily in dealer speed training and machine interface design specifically to maximize rounds per hour, the same variable that sits directly inside the theo formula described above. Free-flowing alcohol service to active gamblers, legal and standard practice on most gaming floors, similarly correlates with looser betting behavior and reduced attention to bankroll management, which is why it's offered proactively to players who are actively wagering, rather than sold as a standalone bar product the way it would be in a nightclub. The structural choice underneath all of this, commercial, tribal, or racino, and each operates under a completely different regulatory ceiling. Commercial casinos operate under direct state licensing and taxation as described above. Tribal casinos operate under a fundamentally different legal framework entirely, the Indian Gaming Regulatory Act, through compacts negotiated directly between a sovereign tribal nation and the state, which means tribal gaming revenue isn't subject to standard state corporate taxation the way commercial gaming is, though compacts typically include negotiated revenue sharing payments to the state in exchange for exclusivity in a given region. Racinos, casino gaming attached to a horse or greyhound racing license, exists specifically in states that wanted gaming tax revenue without fully opening a commercial casino license process, and they typically operate under more restrictive game-type rules, often limited to slots and electronic table games rather than full table games with live dealers. An operator choosing between these three paths isn't choosing a business model so much as choosing which regulatory ceiling and tax structure they're willing to operate permanently under, since converting from one framework to another after the fact is rarely straightforward and sometimes not legally possible at all. The hidden cost that doesn't show up in a standard hospitality pro forma. The infrastructure has to be sized for a small city, and it doesn't scale down if the gaming floor underperforms. A resort-scale casino's power, water, and climate systems are sized for peak occupancy across a hotel tower, multiple restaurants, an entertainment venue, and a gaming floor that, in many jurisdictions, is legally required to maintain specific air quality and temperature standards regardless of how many guests are actually on it that day. Unlike almost every other business in this series, this infrastructure cost doesn't meaningfully shrink if the property underperforms. A half-empty casino still has to run essentially the same central plant as a full one, which means the fixed cost floor on a casino resort is exceptionally high and largely insensitive to the demand variability that smaller businesses can at least partially absorb by cutting staff or hours. Two ways to get exposure to this industry, and they map onto a split that's now structurally embedded in how the sector finances itself. Direct casino ownership captures the full operating margin and the full house edge economics described throughout this video, but carries the complete licensing, compliance, and capital intensity risk laid out above. The second path runs through the operator versus landlord split just described. Buying shares in an operating company, Caesars, Boyd Gaming, MGM, captures the gaming floor economics and the Theo-driven comp model, while buying shares in a gaming REIT captures a bond-like, contractual rental stream that's structurally insulated from a bad quarter on the casino floor, in exchange for giving up the upside of a great one, often 15 years or more, with renewal options extending decades further. A gaming REIT's cash flow is about as close to a fixed income instrument as equity ownership of a gambling-adjacent business can get, while direct operator equity remains fully exposed to everything from a regional recession. 4 numbers to check before evaluating a specific casino investment. First, the jurisdiction's license cap and where the specific property sits relative to it.
Second, the blended house edge and game mix the property actually runs, not an industry average figure. Third, whether the underlying real estate is owned outright or subject to a REIT lease, and if leased, the fixed rent escalation schedule over the lease term, since that number effectively sets a floor under the property's fixed costs. Fourth, regional gaming revenue trend and competitive pipeline, specifically how many new licenses or expansions are pending within realistic drive time, since Revel's collapse wasn't caused by anything happening inside its own building, exactly the kind of market-level risk that no amount of internal operational excellence can offset. Where the model breaks, in one of the most expensive single-property failures in American gaming history. Revel, a $2.4 billion casino resort on the Atlantic City Boardwalk, broke ground just before the 2008 financial crisis, ran out of construction financing partway through, and had to drop plans for a second hotel tower while scrambling to raise the roughly $1 billion still needed to finish the project. It opened in April 2012 as the tallest building on the Jersey Shore, positioned as a smoking-free, high-end alternative to Atlantic City's traditional casino floor, choices that alienated a meaningful share of the market's core gambling customer base.
It filed for Chapter 11 bankruptcy less than a year after opening, filed again roughly a year after that, and closed permanently in September 2014, having never turned a profit across its entire operating history. At auction, the $2.4 billion property sold for $82 to $90 million, roughly 4 cents on the dollar. And even at that price, serious casino operators largely stayed away. The eventual buyer was a real estate developer with no prior casino experience. The property's dedicated $129 million central power and climate plant was owned by a separate energy company under a long-term supply contract, meaning any buyer wasn't just acquiring a discounted casino. They were acquiring an ongoing expensive utility obligation. The lesson isn't that Atlantic City stopped generating gambling revenue. Competitor properties in the same market continued operating throughout Revel's entire collapse. The lesson is structural, and it's the same one that closes almost every video in this series. Revel's core games carried the same mathematically guaranteed house edge as every other casino on the boardwalk. The house edge never failed. What failed was a capital structure that spent $2.4 billion building a property, more than the debt load any Atlantic City casino except one had ever successfully carried, in a market that was already shrinking as Pennsylvania, New York, and Delaware opened competing casinos and pulled Atlantic City's total gaming revenue down from a 2006 peak of $5.2 billion to roughly half that by the time Revel opened. A guaranteed mathematical edge on every individual bet says nothing about whether the fixed costs sitting on top of that edge, construction debt, an oversized utility plant, hundreds of millions in annual interest, can actually be serviced by the volume a shrinking, increasingly competitive regional market can support.
Every mechanism covered in this video, the license scarcity, the calculated house edge, the Theo-driven comp system, the REIT lease structure, the casino's core product is mathematically guaranteed to be profitable per dollar wagered, and yet the industry remains one of the most volatile, most heavily leveraged, and most failure-prone sectors in American commercial real estate. That isn't a contradiction once the actual risk is located correctly. The risk was never in the games. It's in everything layered on top of the games. How much debt was used to build the building? How oversized the fixed infrastructure is relative to realistic demand, and how much of that demand can evaporate the moment a competing jurisdiction opens a license 2 hours down the highway. The break-even, plainly, expressed the way the industry actually models it, through handle, not through simple revenue. A mid-sized commercial casino with $150 million in annual fixed costs, debt service, licensing and compliance, base payroll, facilities, at a blended house edge of 4% across a mix of table games and slots, that requires roughly $3.75 billion in total annual handle, total dollars wagered, not total dollars lost by customers, to clear fixed costs before a single comp, marketing dollar, or return to equity holders is considered. That handle figure is the real capacity question every casino investment ultimately answers. Since a property can have a perfectly guaranteed house edge on every single game on the floor and still fail entirely if the regional market, given competition, population, and drive time access, simply cannot generate enough betting volume to move that edge across a large enough number to cover what the building itself costs to keep running.